My name is Phil Thomas. I'm the Director and Founder of London South East. Thank you all for coming. We've got some great speakers today. First, a thank you to City Index, who are sponsored tonight. Appreciate those guys being here. They've got a demo outside as well, which I'm sure they'll be very pleased to show you if you've got a few minutes afterwards as well. The LSE website gets around about just short of 1 million people visit it every single month. 30 million pages of content are served, and that's growing month on month. We're very, very proud of that. We're also currently testing out our new version. We've got a new one that's much better on the phone, mobile phones, which we're hoping rolls out in the next month. That's about me. We've got some great speakers today. I've got Hayden Locke, who's the CEO of Emmerson. There's been 15,000 people looking at the Emmerson pages in the last month on the website as well. George Frangeskides, I hope I pronounced it correctly, from Alba Mineral Resources. There are about 32,000 of our users look at their pages as well, which is wonderful. There's also, I know they've had an RNS today, and their share price has done something rather dramatic, so congratulations on that. And I think we've got an interview with those guys next week as well, so please do look out for that. Also got Mark Childs of Condor. 18,500 people have looked at his pages on our website in the last month as well. And of course we've got Paul Mylchreest, who's an equity analyst from Hardman, who we're very pleased to be with us as well. And of course we're hosted by the wonderful Nigel Cassidy, who will look after us, and I shall hand over to him. Thanks a lot.
Thank you very much indeed, Phil. Very good evening to everybody. Well, they say in investment, don't they, timing is everything, and certainly natural resources, many mining stocks are at a 7-year low, and we know some players are finding it hard to raise funding capital as a result. So the good news really regarding the timing is that we might be at the bottom of the cycle, which everybody of course is looking for. And you might say, well, this is pretty ironic, seeing in many cases we're talking about precious natural resources, which there's an extraordinary demand for. We know, of course, about batteries. I was reading only the other day how the change to green technologies, which you might think would be completely at odds with traditional oil and gas and all that, but in fact they have a terrific need for precious resources. So the demand is certainly there. And we're also covering gold. We've been hearing in the last few days with all the trade concerns at the moment. Safe havens are once again in demand. The gold price is higher than it has been. So, well, we can only congratulate Gordon Brown, can't we? I think it was exactly 20 years ago when he started selling gold at the bottom of the cycle. Anyway, that's enough from me. Let us move on to our first speaker, who is Hayden Locke, the Chief of Emmerson PLC. This is a very well-funded, a sector-leading company. It's been showing a great deal of promise and a rising share price. His background is in engineering, in commerce and geology, a highly experienced mining executive with 15 years experience, so the floor is yours.
Thank you. Thank you very much for the kind introduction. I'm talking about Emmerson PLC. We're developing a potash project in northern Morocco. I think we like to think of ourselves as a high-impact potential investment for investors, but the comment at the top is from a very well-respected equities analyst in the City of London who recently initiated on us, and I think really what came out of his initiation note is sector-leading capital intensity and capital cost to production, and bottom quartile all-in sustaining cost. That is a very rare combination indeed, and something that excites us a great deal. So Chemisset, which is located in northern Morocco, is, I think it's a fairly grandiose claim to say, it's a world-class asset. But what is it about it that makes us believe that this is world-class? Well, I've already addressed two of the issues, which is, number one, the capital intensity of this project is significantly lower than virtually every other development stage potash project in the world. We're in the bottom 2 or 3 in terms of total capital cost, and the margins are nothing short of outstanding. So based on today's prices, we're talking about EBITDA margins approaching 70%. That is very rare in the mining industry in general, and certainly amongst potash projects in general. As a result, the economics that we put out for our scoping study, which we released in November of last year, are nothing short of outstanding. So an NPV 10 post-tax using industry expert price forecasts of well over $1 billion, very, very low capex, as I said, and a minimum 20-year mine life. So this is a very long-lived asset already, and there's plenty of potential to increase the size of that resource with a lot of ongoing exploration work. We're currently drilling on the project site. So what we see on this diagram is the extent of the basin it's a very, very large basin. And the resource that we're currently basing our studies on, which is 20 years of mine life, is a small proportion of that. There is significant potential to increase the size of this mine and the length of this mine through ongoing exploration work, which is happening right now. If we think about the potash industry in general, and it may or may not be a mineral that you're familiar with, it's the name given to any mineral that contains potassium and is used in fertiliser. It is an incredibly tightly controlled market. So until recently, there were 11 producers of potash globally. There have been really the dominant 3 or 4 producers are 2 Canadian companies, Mosaic and Nutrien, and then Uralkali and Belaruskali, controlling about 70% of global supply. This is a product that if you're going to participate in the global fertiliser industry is a mandatory must-have. You cannot be a player in the global fertiliser industry without access to a significant source of K. As a result, and this slide here is really just to show the sorts of groups that might have strategic interest in an asset like this. There are literally hundreds of them that would love to be able to control their own source of potassium, their own source of potash. And certainly they've tried to get into the industry. I think BHP may or may not be on there. Yep, it's over in the corner. World's largest mining company has seen the potential of entering the potash market, but it is an incredibly difficult market to enter, mostly in the form of very high barriers to entry due to astronomical capex for most potash projects in the world. That is one of the key drivers and the key reasons we're so excited about the Chemoset potash project is the small capex relative to most of our peers and therefore its imminent financeability. But I think it takes even another step in its strategic importance. In the world, we're talking about the population in the world growing by 2.2, 2.3 billion people over the next 30 years, over an ever-shrinking amount of arable land. So the UN Food and Agriculture Organization estimates we're going to have to produce 70% more food from a shrinking amount of arable land in order to feed all of those people. Where is that arable land going to come from? And the answer is Africa. Africa has 60% of the world's uncultivated arable land. And as this diagram shows, you may not be able to see it, but the red indicates low fertiliser usage. It is among the lowest fertiliser usage in the world today. It's partially driven by the fragmented industry in Africa, but in terms of growth for fertiliser demand, Africa is the future. And every single fertiliser company in the world recognises that Africa is the future. And as a result, there is a huge amount of interest in African projects such as Chemoset that could potentially feed this really strongly growing pipeline. Morocco is at the forefront of that. So there is a very large company in Morocco called OCP, which I had on the slide previously. It's the world's largest producer of phosphate, so a very large fertiliser company. Little known fact is Morocco has 70% of the global reserves of phosphate, which is one of the three key macronutrients used in the fertiliser industry. About 5 or 6 years ago, OCP made a very clear shift from just producing phosphate-based fertilisers to producing a far more diversified product suite. Key in that is potassium. And as you see this diagram here showing the growth in imports for potash to Morocco places it in the top 5 fastest growing nations for potash consumption in the world today. It's growing at 70 times faster than the market rate, the global market rate for consumption of this key mineral that we are going to be producing at the Chemoset Potash Project. So I think if you've connected the dots that I have through my time doing DD on this project, OCP has the potential to unlock all of the value in this project. And we see them as a logical partner in the future, and certainly somebody that we would be selling product to in the future. Significant demand profile from them. Morocco is an amazing jurisdiction to operate in. I've operated in Mali, in Côte d'Ivoire, Senegal, but throughout West Africa, and Morocco is very, very good in terms of a relative comparison to those jurisdictions. The World Risk Report, which is put out by Mining Journal, is a fantastic ranking system. Obviously, I would say that. It's got Morocco as the #1 African jurisdiction. But if you read their reports, there's a huge amount of detail that goes into that and quite an objective methodology used to lead to those rankings. We found it to be a fantastic place to work, hugely supportive. They're really, really pushing to attract companies like us to come into the country. That's really seen in the fiscal regime that they've recently put out, where they have a 5-year tax holiday, all of the usual good things. A 5-year tax holiday, they actually have a 50% reduction in corporate tax rate for products that are exported, which luckily we will. No royalties, and probably most importantly in Africa, no requirement for the government to own any proportion of our project, and no mechanism for them to take any of that project from us. So having said all of that, the question I pose, and I don't want to tell anyone what to think, but is the market valuing this asset correctly? We have delivered our first technical study. We're a long way through delivering our second portion of technical work, and we're targeting the delivery of a feasibility study by Q1 of next year, which will mean that the project is significantly de-risked relative to our starting point. And if you look at it just as a function of our NPV, we're trading at about a 96% discount to our NPV. If you look at our peers in the industry, and I use a couple of peers, Highfield Resources, who I used to work at, one step ahead of us in terms of they've delivered a feasibility and they're now waiting for their permits to start building their mine, capped at £125 million. And the obvious one, which I'm sure we're all familiar with, Sirius, one step further ahead again, capped at nearly £1 billion. So a significant discount to the intrinsic value from our perspective, and we look forward to delivering more and more news flow that will help push us back up that value curve a little bit. People are starting to take notice. It's been a long and slow battle, and I have a couple of team members here who have been working hard on getting the story out to investors like you and saying, you know, here's what we're going to deliver, and we've delivered on everything that we said we would. We will aim to continue to do that as we take this company through all of the de-risking milestones. And of course, strongly supported by Shard. So our broker, Phil Swinfen, as I mentioned, one of the best respected analysts in the City of London for mining, wrote a very favourable piece on this potash. He covered actually Highfield Resources back in when it was in its infancy, has a lot of knowledge about the industry, and of course gave us a very glowing appraisal. And this is just a snapshot of his note, showing that based on the scoping study, he sees the value of this company at more like 12p a share. So an uplift from today's price at 2.3. When he put the note out, it was more like 3.5 times. But once we deliver the feasibility study, that price target goes up again because we have made a significant step in de-risking this project. It's always important to talk about the experience of board and management. So a couple that I'd like to draw out here. Number one, Mark Connolly, who's the chairman. Mark and I worked together at a company called Papillon Resources, which was a small gold company that we took through exactly this phase of development through a scoping study, feasibility, definitive feasibility, and into construction, and then sold to a large Canadian company for about $600 million. Mark has a huge amount of experience building mines in Africa. The reason I wanted him to be involved in the chairman position is just because of the network of people that he has who have the capability to deliver what is a large and complex project in Africa. So he has a huge team of guys that are available to him to execute on a project like this. And then obviously myself, my experience is working in development at Papillon Resources, but also I've got now about 5 years experience in the potash industry, which shouldn't be underestimated because it is a non-standard mineral that requires knowledge of the ins and outs of the mineral to ensure that mistakes aren't made. We talk a lot about 2019 being a transformational year, and we're working extremely hard to deliver on as many milestones as we can. But I think we're pretty proud of the fact that we've delivered on quite a number already. We've only been listed less than 12 months. In that time, we've delivered a significant amount of technical work. We've delivered a scoping study. We've delivered a MOU for offtake for 100% of the product from this project. We've signed MOUs with in-country partners like Africagas, and there'll be more of those coming. We've commenced the feasibility study. We've commenced the metallurgical test work, which will be finished towards the end of June and released hopefully in July. We're a long way through our drilling program, so we're more than halfway through the drilling program, which will lead us to an updated resource. And we've completed our initial environmental baseline study, and we're about to commence our ESIA, which is really looking at converting this project from a research permit or a exploration permit to a mining permit. So we're pretty impressed, we're pretty excited with the amount of progress that we've made, and it's going to continue for the rest of this year and into next year as well. So we have a significant amount of news flow coming, some of it very transformational for the company, some of it more about communicating with our shareholders, but we are accelerating the development of this as quickly as we can, and we see a lot of potential to increase that development as we move towards the closer de-risking milestone of delivering a feasibility study. In summary, as of today, and I put this out in an announcement last week, we have £2.3 million in the bank as at the end of March. That funds us right through all of the work we have planned thus far. So we are well funded to deliver on all of those milestones. We're in an amazing jurisdiction in Africa, in Morocco. It's one of the best jurisdictions, we think, in Africa. We've got an experienced board and management, and the potash market is certainly a good place to be at the moment, with multiple record years of demand. So thank you very much for your attention, and happy to take any questions.
Thank you very much, Hayden. So obviously it's a company people have been looking at on the LSE platform and others. So what questions do we have from the floor? Yeah, one over here.
Can you tell us about the quality of the material and the grades that you're getting, and therefore the acceptability of the product that you're like to get? Or maybe your test work isn't complete yet, but give us some indication of that.
So the product that's produced is a standard K60 MOP, so there's no difference in our product to any other product that's sold. Some of them are slightly higher grade, but the minimum threshold that you have to meet is what's called a K60 product, which is effectively a 95.5% pure potash. So the product that we will produce is exactly that, and the process circuit has been designed to produce that. In terms of the grade in the ground of the resource, it's about 10%, a bit over 10% K2O grade. That's middle of the road in terms of global potash projects. The Canadian grades are very high, but the main difference, and the bit that really is the competitive advantage of this project, is its location. Transport and logistics in the potash industry makes up a significant percentage of the total cost structure in the industry. So for the Canadians, it's more than 60% of their delivered cost to their customer. The location in Morocco is so good that we more than make up for the difference in our grade by that location advantage.
Right, there was a question over here. Oh, well, take that one first. Over there, yeah.
How does the quality, cost of extraction and longevity compare with, say, the Woodsmith mine up in Yorkshire?
So it's obviously a lot smaller mine as it currently stands. It's a 20-year mine life. We've probably left out another 10 years of resource as it currently stands. And then with exploration, I'd expect there'd be at least another 10 years, maybe more in terms of additional resource. Woodsmith is 100 plus years. I mean, it is an enormous resource. So in terms of the scale, it's going to be a significantly smaller project. And I think that's reflected also in the CapEx. In terms of the product itself, we are producing a product which is, it's a well-known K60 MOP product. So it is the main potassium-based fertiliser sold in the world today. It's about 67 million tonnes a year. The polyhalite product is slightly different. So it's got potassium in it, but it also has a number of other minerals. So it's not really comparable. And I actually think it's probably complementary in the end. They're more competing with the SOP, the chloride-free market.
Question over here.
Where are you planning to get your process water from, and have you got enough of it?
So there are a couple of options for us. There are a number of lakes nearby, and there's also a major river. In terms of process water required, if you look at it on a relative scale in the mining industry compared to, say, copper versus potash, it's not a very water-intensive industry. The first lot of water that comes in is then recirculated, so we have a recirculating brine going through the circuit. It's really only when we have to purge a little bit out of the circuit that we need to make up more water. So the actual water demand is not massive, but the alternatives are the river, which is a very large waterway indeed, which is about 5 kilometres from our project, and 2 large lakes. And then also we're about 60 kilometres from the coast. the benefit of going to the coast is we are actually looking at using a salty brine in the process, so it makes sense to go to the coast and then pump the salt waste the other direction out into the sea. All of that will come out of the feasibility study. We're weighing up which is going to be the best option for us as part of the feasibility study.
Can I ask you about the pressures to be cleaner and greener? What are the environmental challenges, if any? Because obviously all energy companies, resource companies are having to look at these issues.
Yeah, it's an issue across the industry, and I think it has to be a focal point. So for us, the way we'll approach it is very much on trying to be adherent to the IFC performance standards and the Equator principles, which kind of outline how mining companies can do this with best practice, dealing with not just environmental but social issues as well around the mines. So it is a big focus for us, and that'll be part of the ESIA study. In terms of the potential impacts of this, it is no doubt a large project. One of the benefits we have is a significant amount of it is underground, so we have a fairly small surface footprint, but there's certainly the usual things: noise, dust pollution. The biggest single issue will be the byproduct, which is salt. So salt, in terms of the scale of, I guess, nastiness, salt is a very benign byproduct to have. There's no cyanide, there's no acid leaching, none of that sort of stuff, but it's still something that we have to be mindful of. One of the benefits of this project is actually the salt that we produce is a saleable byproduct into the US de-icing salt market. So there is a potential additional revenue stream there that we will examine as part of the next phase of study. And in fact, Morocco has a very large salt producer already producing, who we're in early stages of conversations with about potentially partnering on that salt byproduct.
And there is concern about intensive use of fertilisers. You talk about Africa being the next big market. Is that something which there might be some pushback on?
I mean, I think we're already seeing it a little bit. I don't think it's going to be an issue in terms of the overall demand for potash itself, because unfortunately there is no substitute for it. But I think what we're seeing is the education process for what we call smart fertiliser use, i.e. more efficient use of fertiliser, is really coming to the fore. But that's really focused more on the nitrogen end of the scale,
sure.
Which is far more prevalent and more widespread in its use and overuse. So yeah, it's certainly an issue that the farmers have to face, but for the time being, there's no substitute for it. So they'll continue with the way they're going.
Question over here.
And how do you expect to stand out from the rest of the herd? Because there are companies way ahead of you, and so I'd just like to understand how you're going to play the game and capture a certain percentage.
Yeah. Other than Sirius and Highfield, are there other companies that you're referring to specifically?
Well, well. If you look at the vertical, generally speaking, there are a number of players internationally, and that's what I'm referring to.
Yeah. So I think I mentioned it a little bit. Potash is an incredibly tightly controlled market. So one of the most amazing statistics about potash is there has only been one greenfields potash mine built in 50 years outside of China and Russia. That was built in 2017 by a company called K+S. It is really reflective of the barriers to entry. It is an incredibly tightly controlled market. Very few companies get into this market. What sets us apart from virtually every other potash project is, number one, our capital intensity. So we can actually finance a potash mine in a downside price scenario. And having been through it with Highfield Resources, I know how the banks approach this, because you can't hedge potash. They do look at it in a downside scenario. And then the second is, we're very cognizant of the fact that we need to focus on those areas where we have the best strategic advantage. And that strategic advantage for us comes in the form of our closeness to our end markets. So we're going to focus only on the markets that I call the Atlantic corridor. So we're talking anything from Morocco to South Africa to Brazil to Northwest Europe and even into the Caribbean. The reason we focus on that is because we have such a big advantage over the Canadian and Russian producers that we'll always be competitive into that market. If we can do that, the price will fall, the price will rise, but we'll always make an acceptable return on invested capital because of that advantage.
Lady over here.
Just taking from what you've just explained, and you looking to go into other countries like South Africa and all that, so would you be looking to go into countries like Zambia? And if you are, because it's in the southern part of Africa, and if you are, Zambia is a landlocked country, but when you were explaining with the byproduct of your mining, you were talking about a solution of actually draining into the sea or something like that. So how would you go around that within a country like Zambia?
So all of the byproduct would be focused in Morocco. So we're not moving the byproduct to any of the target markets. And I think it's important to note that we're not sorry, go on.
No, I'm saying if you had to go into a country like Zambia, because I know at the moment you're in Morocco, but would you be looking to go into other countries? Like how you were saying, you have advantage over like other countries, other companies, and you'd be looking to go into places like South Africa, the Caribbean and all that. So if you had an opportunity to get into Zambia, because I want to have a conversation with you afterwards regarding this, but if you had an opportunity to get into Zambia, you were talking about the byproduct, how you drain it into like the sea, and Zambia is a landlocked country. How would you go around that? Well,
I think to be clear, the geological asset is located in Morocco. So we're not looking at a geological asset in Zambia. What we would be producing is a product based on the geological asset we have in Morocco that we can then sell around the world. So we would ship it from Morocco to a country like Zambia or South Africa and to be sold there. Now, we're not going to focus on actually selling into each of the countries, primarily because fertiliser sales is an incredibly sales-intensive process, and you need to have offices in every single market around the world. What we'll focus on is selling to the fertiliser producers, the people who produce the final fertiliser that is sold to the farmers. They will have distribution offices in Zambia, they'll have distribution offices in East Africa, in West Africa, in Brazil, and then we'll sell through them. But all of our production will be done in Morocco, and we will be exporting a finished product.
Okay, understood.
Okay, time for just one more question. At the back.
Regarding production, are you going to do it yourself, or are you going to have a partner, or what, farm out, sell out?
It's a good question. I think it's still a fairly large capital bill. I mean, less than 10% of the last potash mine that was built, but still $200 million of equity required. It makes a lot of sense to talk to potential strategic partners, and we know all of the potential strategic partners in the space. There has been a lot of interest, inbound interest in what we're doing, but it's a time-consuming process to go through those discussions. I think one of the things about the board and management is we have raised north of $500 million for mining projects like this over the past decade. So there's certainly, we have the capability to raise the money, but we'd also see potential advantages in having a partner. The obvious one is OCP. They make a lot of sense to be our partner in this. And I'm sure as we get closer to production, those conversations will start.
And you've talked about the future. Obviously, investors like a bit of action, and they can be left waiting. What are the big highlights that could move the share price, would you say?
So of the work we've got ongoing at the moment, we have the metallurgical testing, which will be done towards the end of June to be released hopefully in July. We've got the drilling underway, which will result in an upgraded resource, mostly about confidence, but potentially expanding it. We've got early stage discussions on financing side. We've got early stage discussions on strategic partnerships in countries similar to the Africa gas discussion. And then obviously the feasibility study is a huge piece of work, but we're going to break that into smaller components as we did for the scoping study, and we'll continue to release those to the market with a reference back to what it means and how it compares to the scoping study. So people should be able to form a view of what our feasibility study will look like before we release it. So there's a lot of things going on.
Thank you. Very comprehensive. That's Hayden Locke. Thank you very much. Okay, well, we move on now to George Frangeskides, who's Executive Chairman of Alba Mineral. Now, Alba gave investors a pleasant surprise with an announcement to the RNS. I guess for everybody here it will be even more pleasant if it had been tomorrow, but you can never time these things absolutely. That was relating to the Tall Black Sands project. I'm sure we'll hear a lot more about that in the quest for titanium oxide. The next chief here, in fact, he practiced as a lawyer, although, of course, he's very
Don't
much
hold
involved.
that against me, though.
And not his fault, but a lot of experience clearly in the mining industry, skilled in strategic planning and strategy and leadership. Alba is quite a broad-based company with all kinds of things going on in Wales, in Greenland, and the UK Weald, among other places. So let's hear more about it.
Okay, good evening, everyone. So Alba Mineral Resources, this is our disclaimer we have to put out, of course. A little note about our competent persons. And a snapshot about us. A bit envious about Hayden, who's already left because he's very busy. It's obviously a fantastic project, but I'm envious also because he's got one project to talk about. And we've got several at Alba. So in terms of investor interest, we've certainly got that, and news flow. So in terms of what we are, we're quite unusual as a junior miner. We're a mining exploration company. That's how we started, but then we got into oil and gas investment. So we've now got a suite of mining assets that we control, and we've got a couple of investments in the UK onshore oil sector. We like to think that we've targeted some really good assets. We've got high-grade assets like our ilmenite, which we'll come to. Our graphite is exceptionally high-grade. We've got high-value metals up in northwest Greenland. We're in Greenland in a big way, which I'll explain a little bit more about. We've got a high-grade mine, the UK's largest ever producer of gold, the Clogau Gold Mine, which we control, and we're about to start drilling in Ireland. So that's a pretty busy roster of projects. So that's where we operate from. So you'll see in Greenland we've got 4 main projects. There's 3 in a cluster up in northwest Greenland, and 1 down in the tip of southern Greenland, which is actually on the same latitude as the Shetland Islands. So if you think of it that way, Greenland is an absolutely massive country, of course, but certainly down there in the southern Greenland, you know, we can work pretty much year in, year out, and throughout the seasons. I thought I'd touch first on our Clogau Gold project because it's been in the news recently. So we announced some really good results in our regional exploration work that we've been doing in the Dolgellau Gold Belt. This is a unique story. We've got most of the gold belt, the Dolgellau Gold Belt, under license to Alba. If this was in West Africa, where I've done some work in the past, you'd see 20 or 30 companies owning little pieces of this and trying to sell their project as being the best bit of the gold belt. Well, apart from one little bit in the middle, which is owned by the owners of the Gwynfinith mine, we own the gold belt. I shouldn't say that if the Crown's listening. We're under license from the Crown Mineral Estate. So, but we have an exclusive license over this 30-kilometre gold belt. It's a known geological formation. We know and have plotted over 300 gold occurrences and trial workings over time. There is only there were 2 mines in production. We have the Clogau Gold Mine within our licence. We think there's a very good chance that there are other Clogau gold mines, in other words, other significant deposits of gold that have never been worked before, never been found before. We like this project as well because it's unique in its connections to the royal family, it's in connections to the heritage of Wales in particular, but the UK as well. It attracts a significant premium over normal spot rates. We like to talk about a 2 to 3 times premium because of its scarcity value and because it has that cachet of being Welsh gold and the royal connection. What we're doing at Clogau is some mine redevelopment. So there's a very, very extensive workings underground. So in this here you'll see 2 main adits. So the upper adit here is the Tinny Cornell in red, and then down here the Lech Fraith. These are really significant development. There's many, many levels here that you can see. Some of that's been worked out, of course, but all the old timers were doing was essentially following the vein. This is a narrow vein gold deposit, and they were just chiseling it out, seeing the vein, following it as they go. And we like to think we can do a lot more than that. We've gone in and done some very systematic things. Some modern exploration has been employed here. We've done underground scanning. We've been doing the regional exploration, which I'll come to. And obviously what we're trying to do here is unlock the unworked veins of gold that we think do exist. but typically they're randomly distributed. So this isn't going to be a drill it out and get a JORC resource. This is going to be do clever things to go and find the gold that we think is still in that mine, and at the same time go into the regional exploration in a big way. So talking of region exploration, we've been doing a lot of what I guess would look like very mundane work. So just soil sampling over a grid, effectively over a grid pattern of many miles. We've covered about 4 miles now, the Dolgellau Gold Belt, in 3 months. And we've been taking soil samples. And what we're trying to find there is whether we can see gold in the soil. So we send the soils off to the lab, and they tell us pretty much uniformly there is gold. Throughout those 4 miles that we've so far tested, there is. And we're only looking for low detection limits of gold here. We're not talking about the stuff that we really want to mine, that's underneath in the formation itself. But we are finding, as I say, consistent, decent grades of low-level anomalism. So this was what we did in 2018. We started doing this regional work, and then this year we've really gone into it in a big way. So the 2018 work were these red lines here, where we were basically going over the old mine, and we thought, well, if we can do the soil sampling over the old mine and we don't find gold, there's something wrong, right? But we obviously did find gold because it's over the mine, and you'd expect to find gold in the soil. So we said, okay, well, this is working. So now we've been rolling this out to some of the rest of the gold belt and all these yellow lines here. And consistently, we're finding gold in the soil. And this isn't a surprise. This is a gold belt, right? So if we didn't find gold in the soil, we'd be very surprised. But what we're finding, and I'll come to the next slide before I talk about this one, what we found so far is a correlation of these results. So the red areas here are over mine working. So this is the anomalism. These are the results we've found over the old mine workings that we know about. So again, that's not surprising. What is surprising and nice, very nice, is that we found 5, and these are the yellow targets here, 5 areas where we're seeing consistent gold grades, and these are definite targets for gold. And these do not coincide with known historical mine workings. So I think so far we're pretty excited. We've only scratched the surface, really. We've done 4 miles. We're in the field as we speak. We're carrying on. We're going to hopefully cover at least 50% of the 30K gold belt by the end of this year. There's lots more results coming out like this, we hope. Certainly the soil samples just keep getting sent to the labs, and we'll be sending out updates on how we're going. So it's pretty exciting, as I say, and it's a pretty unique story. But having spent about 10 minutes on that, I think I should probably move on. We're about to go drilling in Limerick. So we've had this project for some time, before my time actually. It's been in Alba for a long time. Alba was listed with Irish and Scottish exploration licenses, and this is the one that we've got remaining. We are surrounded in this area, this is us here, we're surrounded by very active explorers who do a lot of drilling and getting some very nice results. This is a zinc-lead district. This is a world-famous, world-class zinc-lead district. Some very big deposits here. Europe's largest zinc deposit, Tara. These are all mines. Lisheen, Galmoy, these are all closed mines, admittedly, but they were all in production. Very high grades, 10%, 15% zinc. What we think is that we've got at least 5 targets at Limerick that we want to drill. We may not get to all of them this time round. We had our consultants who are very experienced in Ireland look at our ground when we were deciding what to do here, because it wasn't a tier 1 asset, it was a tier 2 or tier 3 asset, we thought. And our consultants who are very experienced in this ore field in Limerick were amazed that it only ever had 5 drill holes put down on this ground. I mean, given where it is, it's a strategic location, and they just were astounded. So they've come up with at least 5 targets there that we are high priority targets for drilling. We're just waiting on a water discharge permit from the council, such is life. As soon as we get that, we'll be in and start drilling. The next thing to talk about really is Greenland. So if you don't know Greenland for mining, it's got some pretty big projects. It's got a very supportive mines department. and we've certainly found that all along. I mean, we got involved about 4 years ago with our graphite project, and since then we've looked for other projects in Greenland where there's an opportunity, and we've built on that foothold that we started with, and now we've got a significant foothold. We're one of the key explorers in Greenland, and we're doing proper work here. We're not sitting on assets, and in Greenland, in fact, you've got to use it or lose it. So it encourages people like us to do work and keep going, or give it up if you don't think it's going to work. Nigel alluded to this. This presentation, unfortunately, is already out of date as of 3:55 p.m. today, because we put out an announcement on our Thule Black Sands deposit. Now, this is our very high-grade ilmenite deposit in northwest Greenland. It's next door to a project that a lot of you will know, which is the Dundas project owned by Blue Jay Mining, who've done phenomenal work. They've got a 100 million tonne resource. Before 3:55 today, we didn't have a resource, at least we hadn't announced one. We now have a resource, a JORC resource on our ground as well, and we'll come to that. Why is ilmenite important? Because it's the primary source of titanium dioxide. Titanium dioxide is a whitening pigment in paints and coatings and plastics. It's a multi-billion-dollar market. It's a huge market, and it is growing because of expansion in places like China and India. So this is where we are, the blue dot there, and just south of us, Moriusak, that's where Blue Jay are located, and they've obviously been working on their project 3 years longer than us. We've only been in the field, done one full field season and one mini field season when we first got the license granted. And last year, basically what we did was we did drilling. We went drilling and we drilled these targets. This is beach sands, okay, so this is on the beach. You are walking on it. The high-grade stuff is on the beach. I've got some in my bag, I can show you later. It's nice stuff. It's heavy minerals, highly mineralized. Behind the beaches you have effectively what you and I would think of as sand dunes. They're large terraces, and they also contain ilmenite. They're very large terraces. You can see one in that picture there in the background. That also contains ilmenite. So we've drilled both the active beaches, as we call them, and the raised terraces behind. And we've confirmed we've got 10 kilometres of mineralised strike on our licence area. And we had an independent competent person visit because we wanted to get a resource out of this work, and we've now got a resource. So before I move on, just to explain that, I mean, it's in our announcement, it's not in our presentation, but we have announced an inferred resource of 19 million tonnes, 43.6% total heavy mineral. And of the heavy mineral, the only interesting mineral for us is the ilmenite, and that's about 20.5% of that total heavy mineral. We've got contained ilmenite in our resource of 1.7 million tonnes. So if you think of this as a sort of, if you think of it, and I know Mike, my fellow director, thinks this is an extraordinary figure, but if you were to mine 3 million tonnes per annum, you're looking already, we've got more than a 6-year mine life on that basis. This is only an inferred resource, but it is, you see it, you can see it, you can pick it up in your hands. For us to move from inferred into the other categories is certainly something that we'll be looking to do next. So that's, I'm pretty excited about that. We have only had that project 2 years, and we've got a JORC resource, and I think even just that project significantly undervalues Alba. Amitsoq is our high-grade graphite project that we started with in Greenland. I say high-grade, it's averaging 28% total graphitic carbon. I'm not sure of any other project in the world. Admittedly, this is not JORC yet, but I don't know of any other project in the world, a graphite project that averages 28% graphite. It's phenomenally high grade. It's flake graphite. It was mined 100 years ago. A bit like Clogeye, we're always looking for opportunities where we know there has been mining. We know it's been successful in the past, but we think there's a lot more, and we know there's a lot more graphite there. It was very small scale mining 100 years ago, but we know it was done, and we know that we can build on that. So we're going drilling there as well this summer. And the idea there, I mean, if I have to explain what graphite is for, it has traditional uses, but the key driver at the moment, and will be for years to come, is its use in the electric vehicle sector. So it is the anode material in a lithium-ion battery. And everything we see nowadays, I was trying to buy a lawnmower the other day, and suddenly I'm seeing that you can buy lawnmowers that are cordless. I had no idea. The explosion in these devices is massive already, and is only going to get bigger. So at the moment, and certainly for the foreseeable, there is no substitution for graphite, or effective substitution for graphite in a lithium-ion battery in the anode part. So as I say, we're going to go drilling. We've done a lot of mapping here, we've done a lot of sampling, we've done airborne electromagnetics, we've done the works. The only thing we haven't done is to drill it to know how much graphite there is there. So we're going to be drilling Amitsoq, which is on the right-hand side there. That's the mine, the former mine, and those dots there are some of the targets for drilling. The idea is certainly to confirm the structure that we believe is there, and hopefully to get an initial resource out of the drilling this summer as well. We found the new discovery of graphite that no one knew about on our mainland part of our license called Kalak. That's one of the beauties of it doing exploration. It was not known before. This is another significant deposit on our license, but that'll be a phase 2 drilling program. How long have I got, Nigel? A few minutes. So I won't say much about Inglefield. It's up in northwest Greenland. It's early stage exploration. It's very, very interesting. It's got all sorts of mineralization. If you have heard about the Hiawatha Glacier, there's an impact crater that was found. It was announced a few months ago on the BBC and other news networks. And we're right next door to that. So actually, if you see, this is the impact crater here. And these are our licenses. It's a fascinating part of the world. There's a lot of science going on at the moment, and we're talking to them about collaborating with the scientific groups that are doing work up there. There's a lot of mineralization. We've had a lot of people, experts in the field, look at it over the winter months. We went out and did some work last year on the field. What they're saying is some of this, what we're seeing is gold, copper, silver, molybdenum. Now that assemblage of minerals is typical of a porphyry copper or an IOCG style deposit. These are very large deposits, typically modest grades, which is what we've found. We've found decent but pretty modest grades, but what we're looking for is a large mineralized system. So we're pretty excited about Inglefield. It's had a lot of work in the past done, but we're trying to bring all that work together. We're going out in the field again this summer. What we want to try and get out of this season is early stage exploration, is some targets for drilling next year. Bailey got a minute to speak about our oil and gas. A lot of people like Alba for our oil and gas investments and our investments in the Weald Basin. We are the second largest holder in the Horse Hill Developments Consortium. We've increased our stake at Horse Hill over the last 4 years from 5% up to 18% of the operator. We've now got 11.7% of the project. We put a lot of money into it. We've seen great success and great progress. We're still testing it. We're still producing oil. We started in June of last year with the extended well tests at Horse Hill, and they are ongoing, which is a lot longer than I thought they'd go on for. We've declared the Portland commercially viable, which is the sandstone, which we knew was a producer from other projects in the area. We've also gone in and tested the Kimmeridge, which we are hoping is going to be the big pay zone. And again, that has produced oil, significant oil, day in, day out. And we've had so far about 40,000 plus barrels of oil in aggregate from both layers since we started last June. So it's going pretty well. There's a big plan to go and do some more drilling, I know, from the operator later this year to try and increase the number of barrels that we can tap. And probably no time to talk about Brockham. We've got a 5% interest there. It's next to Horse Hill, and we're hoping that Angus will be able to fix the problem that has arisen with the water inflow there. Just brief finish up. What are our value drivers? It says there that we've got one JORC compliant resource. We've got to scrub that. We've got 2 JORC compliant resources as of this afternoon. We're looking at a further 1 by the end of the year if we can at Amitsoq. We've got historic production in our assets. So we're looking at near-term revenues, both on our oil, on our gold, which we want to get back into production, and on our ilmenite. We've got 30 kilometres of a gold belt under license. So I think we're a pretty unique story. We do have a lot on, but there will be a lot of news flow to come. Thank you very much.
Thank you. Well, an awful lot of different projects. You may have questions or thoughts, so one over here.
In relation to the geography of where you are, do you have a preference of being in the Northern Hemisphere, or are you prepared to look elsewhere for the resources that you're looking for? Are you prepared to go into South America, Africa, or other jurisdictions?
We're always prepared to look at everything. I mean, we see projects day in, day out that come across our desk. We will always look at them. But we have sort of found ourselves in this, I wouldn't call it much of a niche, I suppose, geographically, but we are in the Northern Hemisphere. We're in Europe, Northern Europe per se. I suppose Greenland in some respects is part of Northern Europe, certainly was part of the EU until recently. They were the last people to Brexit, so there you go, or Grexit. So we like where we're operating from. They are safe jurisdictions, they're stable jurisdictions, they've got very sophisticated mining codes. Ireland, got a lot of work going on, a lot of mineral exploration in Ireland. Obviously the UK sector, we know it well. We know that the regulatory burden in the UK is relatively high, because we know that from our oil and gas experience. So, but you know, that's fine. We know what we're dealing with, and we know the hurdles we have to overcome. We have to get planning at Clogau, but it was a mine. It had planning. There's no reason why it can't have planning permission again. So these are the things that we work with, but at least we know what the hurdles are that we've got to, you know, overcome. And Greenland is the same. You know, it's a very friendly jurisdiction. We've got a case officer who deals with us whenever we've got a problem. If we don't understand something, we talk it through, we work it out. And so, you know, in that respect, you know, these are good places to operate. So I would certainly look elsewhere, sure, but I want to look for somewhere where I feel we can operate.
I mean, because of your exposure currently, would you be looking to consolidate what you have, or would you be aggressively trying to grow another portfolio somewhere else?
No, I think we've got to grow what we've got. I mean, I think we've got a phenomenal set of assets. I don't think we can do them all justice, that's for sure. So at some point, maybe soon, we will need to look at what we focus on. So far it's worked, okay? So we have juggled a little bit. We are going to juggle a bit more this year in terms of Greenland. We're going to be going into Amitsoq. We haven't been able to go into Amitsoq in a big way for a couple of years.
You're going to need partners.
We may need partners. We may want partners on one or more of these projects. So we maintain a very open mind about how to unlock value for shareholders. You know, we found that this coastline up in northwest Greenland, apart from Blue Jay's section of coastline, was not under licence. You know, we're always looking for opportunities. For the cost of a £2,000 licence, we've now got a JORC resource that I think is worth a lot more than that, right? So this is what we try to do. We're trying to unlock value for our shareholders by just trying to think outside the box, find projects that are undervalued, maybe we've got past production, something that's tangible that we can work with. So, but for sure, you know, we'll be open to opportunities to work with other partners who are in graphite or who are in polymetallic, the polymetallic sector, like, you know, our Inglefield project. We'll definitely be open to looking at those things, and we are looking at them.
A lot of companies are run by engineers, natural resource, sort of career professionals, if you like. Your background was in law, your expertise is in strategic planning and management and all that kind of thing. Are you kind of at the mercy of engineers saying it's going to come right next week, next month, next year, or does that actually help you with the background you've got?
Yeah, no, I mean, I think I've got quite a good sort of jack of all trades type of background. I mean, I've been in mining for 10 years though, so I'm more a miner now, in inverted commas, than I am a lawyer.
Gone native.
But yeah, I've gone native, but at least, I mean, I know enough to make myself dangerous. I mean, Mike is sitting in front of me, he's 40 years a geologist, and you know, he can tell a few war stories. So we've got a very good, very experienced board. Mike was our ex-CEO, he's still on our board as our senior non-exec. So we've got a lot of grey hairs. Unfortunately, I've got it as well. And so I think we've got a good mix. We've got geologists, we've got mining engineers, we've got Manuel, who's our banker, non-executive director. So I think the mix is quite good.
Any more questions for Alba? Yeah.
Just quickly, your budget and the amount of meterage to drill on Limerick.
We're only going to be doing a short program at Limerick. We're doing about 3 to 500 metres of drilling. It's a short program to hit 2 or 3 of those targets that I mentioned, and then we'll go again. We'll see how it goes. Of course, if it goes well, we'll see it immediately and we might carry on. But the program for the moment is a short program. It puts our licence in good standing, and then we'll see where we go from there.
And the budget?
The budget is 50,000 euros. I mean, that's the beauty of Ireland, is drilling is relatively inexpensive.
And environmental issues you particularly have to deal with? I mean, can you just dig up the beach in Greenland? Is that all right?
No. I mean, it is all right. In essence, it is all right. But of course, there is an environmental piece. So we work with the Environment Agency as well as we work with the Mines Department in Greenland. We will have to do an EIA. We did it at first year environmental baseline study. So we were thinking ahead last year, and we didn't have the resource. We took in a team of environmental consultants to do that first year baseline study. So that plus another year will give us our baseline to then move into doing the EIA work. So it's the same in Clogau. You know, when we put our planning permission in, we'll need to put in an environmental impact assessment with it, and all that work has been going on now for about a year. So we're well advanced, and you know, we know that that's part of the territory.
One at the front here. And then you've got a question. No.
With your Tula Black Sands project, assuming it goes into commercial production at some stage, would you see that being a year-round operation due to the climate, or would it be restricted to summer only?
No, we've looked at that. I mean, okay, so we've sort of scratched the surface a little bit on development, but we've had a little look at it. We've had some people look at that for us. We do think we can probably operate there about 9 months a year. You need winterized operations, so you need to have the right kit, obviously, for what is an extreme temperature, of course, in the winter months. It's quite nice and sunny and blue skies sometimes in the summer months, but obviously there are extremes of temperature. So, but a winterized operation certainly is possible, and we believe for 8 to 9 months a year.
Thank you.
And over here. So I'm giving you the run around.
Sorry, you've got...
You're beginning to tire.
You've got several interesting projects you're working on, all of which are presumably going to drain cash. How soon before you run out and need to get some more? And at that point, how much are you going to need to raise?
Well, I think it depends on what our plans are, and we've always cut our cloth according to what the money we've got. So, you know, that's why, as I said, this year we'll be concentrating on carrying on work at Clogau, which is relatively inexpensive. I mean, just to explain, we've done 3 months of regional exploration. We've done that with 3 graduates and 1 senior geologist overseeing them, essentially. So, you know, we always try to do these things at a modest cost, and that has come in at a remarkably modest budget, really, for the work we've done, 3 months and these 5 gold targets that we've come up with. So,
are they on a bonus?
Sorry?
If they find more gold, are they on a bonus?
I think a beer bonus, perhaps.
Oh, okay.
Yeah, a beer bonus. So, you know, so some of the things we do aren't as expensive as you might imagine, right? Now, of course, going drilling in Greenland, in Emmerson, is going to be a fairly expensive exercise, but it's worth it. If it wasn't the highest grade graphite that I know of, we'd think twice about it, but it is. And it's worth drilling. It's worth getting a resource and proving up the model that we think's there. So, yes, we'll either have to raise again at some point, because that's what we do. We're in a mineral exploration business. We are explorers. We're pre-revenue. We may not be pre-revenue if Brockham goes into production. We won't be pre-revenue when Horse Hill goes into full-scale production. And we certainly won't be when Clogau goes into production. So we've got some assets that we think are near term that will provide that cash flow. We'd have hoped that the oil would have done so by now, to be honest, and it's a bit, you know, it's a bit behind. It's a bit tardy in terms of where we thought the oil projects would be by now. But they're still, you know, we still believe in their ability to bring us cash flow. But until we get real cash flow, of course, we're going to have to continue to look to our, you know, investors and existing investors in particular, and you know, Tap the market. The alternative.
We'll tap them, rights issues, something like that.
The alternative, well, yeah, it would be nice to sort of allow shareholders to participate if you can. It's sometimes a little bit tricky to do rights issues, certainly expensive to do rights issues. But the other thing that I definitely want to look at in trying to be nimble and trying not to have to tap the market is joint ventures and farm outs of interest. We've got a lot of projects here, and we think that all of them really should be of interest to potential partners. We may not want to partner with some of them because we want to sole operate, but one or two of them certainly I think are ripe for a joint venture, and that would then take the funding equation out of the issue for us. So I think that's definitely something that I'm working on. I'd like to see that come to fruition, and then we wouldn't have to tap the market, so we'll just have to see.
Okay, well, running out of time, we've got one more question, I think, over here.
Okay, hello. In terms of Horse Hill, just a quick question. In terms of what sort of estimate do you feel potentially in terms of recoverable volumes? And also, do you have any, in terms of when proper field development will take place after all the sort of your normal flow test, and any spaces for farm-ins and farm-out in the near future?
On those projects, on the oil?
Yes.
Yes. Well, I mean, if we just quickly just look here, I mean, the reserves, there's a 32 million barrels at the Portland, which was an Exodus, in the Exodus CPR. The Kimmeridge is an estimate, it's a huge estimate from Schlumberger of 10 billion barrels. That's unconventional limestones and shale. So the reservoir is potentially massive. These are not banked or JORC or not compliant resources in oil and gas terms, but the potential reservoir is massive, and that's what's exciting about the Kimmeridge in particular. I think in terms of recoverability, we're seeing, I think that we're talking about 8%, maybe 14% with water injection. Those are the sorts of figures that I think that we're looking at, and so far we're not seeing much depletion or much evidence of depletion at all, and we've been testing now, as I say, for 9 months. So I think that's a very good sign indeed. So in terms of farm-ins, farm-outs, for us, I mean, we're heavily invested in Horse Hill. I know there's a plan, obviously, to go and drill at least a couple of wells. Whether we participate in that is a decision that we'll make at the time when we're asked to make a decision on it. That's a politician's answer.
Well, seems a good note to end. So thank you very much indeed to George Frangeskides. Morwood Mineral, thank you very much indeed. So halfway through, we move on to Mark Child now, the Chairman and Chief of Condor Gold. Again, different background. Mark was actually commissioned as an officer in the 2nd King Edward, the 7th Zone Gurkha Rifles, served in the British Army, but has built up Condor Gold. It's an AIM TSX listed exploration company. He's certainly got an impressive record building it up through its 100% owned La India project in Nicaragua. So I'm sure we'll hear more about that now.
Thank you for that. And thank you for attending this evening. Conscious we're 7:25. So I'll get on with the presentation. There's a copy of this on most of your seats, and it'll be on our website later. This is the statutory disclaimer. And it's good to see a couple of familiar faces here, and shareholders, I should say. So the company overview, we're developing La India Gold project in Nicaragua into production. We've got a high-grade mineral resource. Under the Canadian rules, we're dual listed on London and on AIM. We have to split out the indicated and the inferred. So we have about 2.4 million ounces of gold. That's all independently verified. Within the indicated portion, we have a economic mineral reserve, and that's the 675,000 ounce there. We've got the key permit, and this took us 3 years to get the permit. The environmental permit was granted last August to construct and operate the mine for 10 years. And we estimate about between 80 to 100,000 ounces of gold a year. We're also proving a major gold district of 5 million ounces. Nicaragua is mining friendly. Gold's the third biggest export. We've got a strong board and management team. I've mentioned we're dual listed. Strategy statement, we're looking to construct a base case 2,800 tonnes a day, producing 100,000 ounces of gold a year, and materially expand that production. And secondly, we're looking to increase our 2.4 million ounces and double that over time. The investment case, we're undervalued compared with the peer group. I've got a couple of charts following on this. We've got some serious backing from IFC World Bank, Jim Mellon, who some of you will know, and Ross Beattie, who is a notorious investor in Canada. In fact, I've just come in from 3 days in Vancouver last week. I arrived back on Sunday, where I had the pleasure of attending Ross Beattie and Pan American Silver's 25th anniversary. They have several mines, mainly in the silver space, but they also have gold companies too. He's a 7% shareholder. We're $8 an ounce in the ground for indicated, and versus the current gold price. So we're 700 all-in sustaining cash costs. That's lower quartile, and compared with the gold price, which is nudging around $1,300 an ounce. In terms of this 120,000 ounces, we're permitting some feeder pits to come in to add to the already permitted main pit, and I'll come on to that. And in addition to that, we've got 1.2 million of underground, in addition to that 120,000 ounces. Technical studies being completed to enter production early via mining some smaller pits, mini pits within the permitted pit. We've done that, and we continue with the district. So most of you want to be more familiar with valuation matrix than geology and mining terms. And you can see on this, we've got several companies. They're mainly listed on TSX and TSXV. And you can see the price to book ratio ranges up to 0.54 for companies at our stage of development, which is just pre-construction. And some of these don't have indicated ounces either. But we're way down as the lowest valuation on that peer group analysis of 0.11 price to book ratio. And on an ounces in the ground number, this is taking the market capitalization divided by the total number of independently verified ounces of gold. We're $8 an ounce in the ground, and you can see the other matrix here ranging up to $79 an ounce. That's where the market is today. Nicaragua, I was there 2 weeks ago and then went up to Canada. It's mining friendly, it's very supportive of the sector. It's got great infrastructure for our project. We've got roads running through the project, and we've got power running through the project, and there's plenty of water, 3 key ingredients. Going into the project itself, this zooms into only about 10% of the project area. That all adds up to 2.4 million ounces, including the silver gets to 2.4. We've got a huge concession package of 455 square kilometres. We've tied up all the gold district. I started off with just 22 square kilometres 11 years ago here. The core area I refer to as La India vein set, America and Mestiza, and you can see that's in the south. So if we look on the map here, we can see, just making it out, that's La India, America. This is all, they're 1.5 kilometres apart. These are the 3 vein sets that make up 2.1 million ounces of gold, and they can theoretically be mined simultaneously. Where we've, the open pit of 900,000 ounces is the resource that we've got the permits for, and that's by the road. And the feeder pits I've mentioned to you that we're permitting at the moment, in the middle of permitting, are up here on Mestiza. We've got 120,000 at super high grade, 8 grams, and we have another 100,000 on America. So all that is very, very close by to a centralized plant, which we're putting about there on the map, just above the eye of India. So there's 80,000 meters of drilling on this, and over the last 8 years since I've been full-time CEO, we've raised about $55 million. That's all gone into this project. I have no other interests apart from making sure this works. And it's been a bit of a challenge, which I'll come on to in a moment. Here's Landia open pit. So this is, you're looking at here, and underground. So the red line is the vein. It outcrops at surface. It's about 1.2 kilometers long from left to right as you're looking at it. And you can see the first 900,000 ounces that is open pit, and underneath it you've got underground, and it's the open pit part. And you'll see by that that there's no jungle, it's hilly, there's a 10-to-1 strip ratio of waste to mineralized ore. It's very high grade at 3 grams for an open pit. A gram is about $40, a gram of gold. So when you have 3 grams, it's a $120 rock. And I'll turn that into gold. It costs about $50 into a gold bar. So those, you have mining dilution, metallurgical recovery and so forth, but it's, that simple mass checks back to the $700 low all-in sustaining cash costs. The key environmental permits granted. This is a major achievement and a major de-risk for the company. When we started off, we had some resettlement to do. We redesigned the pit, and that's 20% smaller. We've lost about 8% of the gold, but we still can get production out of the permitted pit of 600,000 ounces of gold. So the question, we've run the studies internally, do we mine it 80,000 ounces of gold a year for 7.5 years, or do we mine it quickly at 100,000 ounces of gold for 6 years? Well, we've done the studies, the trucks can fit in and out. We have a fairly small mobile fleet of 40-ton trucks here. And the plant's moved 1.2 kilometers from the village. If we add the feeder pits in, and this is an internal number, the bottom point there, the actual production is 860,000 ounces of produced gold, which is, and that should be a pretty foregone conclusion getting those permitted, I hope. This is the infrastructure layout of the project. This is in Spanish, I'm afraid, but Tahoe is pit, if there's any doubt. And then over to the right, you can see the plant or planter going up here, and the explosive magazines up here. The tailing storage facility is here. So 1 million tons of rock comes out of the pit every year, gets processed through the processing plant, gets pumped under the road into a tailing storage facility. So it's about 500 hectares of land on that mine site infrastructure. B2Gold operate 2 producing mines in country. One is a 50-minute drive and one's about a 3-hour drive. We're permitted to extract 600,000 ounces of gold to produce $750 million. It makes sense for us, if we can, to get cash flow as soon as possible. And one of the things that we've been looking at is toll refining. This is at an exploratory stage, but B2Gold did turn around to us and say, look, we would like to sample the ore at both our producing mines to see what the metallurgical recovery is and the hardness of the rock and how that impacts in their mines and so on. So this is the result. These are independently selected samples of 50 pounds each, or 23 kilos, and the average grade was 12 grams, and the average metallurgical recovery is 95%. So those are fantastic recoveries, and that's taking the principal Landia vein within a permitted pit. So we're very happy with those results. Social benefits. This is a massive thing in any mining projects, as we heard earlier. Permits come from the bottom up, and we have a team of 10 people in the social side. Landia is an old mining town. The mine closed in 1956. There's 42% poverty in that particular town on a UN matrix. We have engagement groups, 6 different engagement groups, from water to pro-mining committees, to healthcare, to youth, working right across that immediate community of 1,000 people and the surrounding communities as well. There are quite a few artisanal mines, mercury rasters, which are pretty horrible because they pollute the environment and don't do humans any good either. But we have a whole stakeholder mapping and detail on all this side. We aim to significantly reduce that poverty in the village, and they all want jobs. This is the second poorest country in the Western Hemisphere after Haiti. Gaining the social license, I've sort of covered a bit of this already. Another key stakeholder is the Catholic Church, who we have a rolling investment program with them on churches and roofs and floors and so on. We're gifting water of 5-gallon water containers every week to about 360 houses. And that gives the social team an opportunity to knock on doors and ask any questions and say, by the way, we're having an inoculation in the village for kids of some, or whatever it might be. So it's an engagement tool as well as a charitable donation in many ways. The IFC remains a shareholder of the company. We are fully compliant pre-construction with their performance standards, and we have generally done in quite some detail all these stakeholder engagement plans, groundwater participatory monitoring programs. This is a major de-risk. The good thing about it is that it's actually upped our game and up the game in the country as a whole, because we've had to hire people internally to make sure we up to these standards and maintain up to those standards. Now, I've mentioned that we're looking to drill the project, prove 5 million ounces, and so that core vein set that I highlighted earlier, you can see that's on the left side there, the 3 vein sets getting to 2.1 million ounces, and we think we can take that to 3 million ounces. We have a drill program to do that, and in addition to that, so that's low-hanging fruit for us, and in addition we have 4 other areas, all of which can be expanded along strike into depth, and particularly Cacao, we're very keen on. I think it hosts over 500,000 ounces on that. The satellite pits, we updated our resource in January this year, and again we had to break down indicated and inferred within our press announcements, but this totals the 287,000 ounces. I'd say we're permitting the 2 biggest ones of those, and that takes our production to 120,000 ounces, and that underground you've got the grades there of 1.2 million as well. This is showing the district. We're about, looking at that, we're about 25 kilometres north-south, 35 kilometres east-west. And in the south you can see La India, which is 1.3 million ounces of gold. And right up in the top right, 10 kilometres from the road, we've got 5 ounces on the surface, 142 grams. And down that entire corridor, we have mineralised. Now, proving a district, how do you go about it? We do soil it's a multidisciplined approach. There's soil geochemistry, airborne geophysics, structural geological models, detailed geological mapping, trenching, scout drilling, and all those things we've done in spades. And what that actually shows is 2 major regional faults, a Landia corridor. These are the black lines going through the project. The faults or cracks in the Earth's surface where the gold comes through. This is a low sulfidation epithermal vein system. And there are lots of telltale signs of a major gold district here. And particularly, so what you have on the structure is you have 2 major faults, the black lines, they move in opposite direction. And at the bottom you can see, you can probably just make out it says the link there. That's a linking structure or fault connecting the 2 bigger faults. And that's where Cacao is, and we've traced that for 3 kilometres on the surface with rock chip samplings. And we drilled it and have a 17-wide intercept of gold mineralisation. In December, just to show the government's permitting, they gave us another concession for 25 years. This is subsurface mineral rights. That's Las Cruz concession. We're particularly keen on it. Before we had it, we rock chip sampled it and soil sampled it. And there's a caldera there and there's copper anomalies. So we think that's the heat source for the project. Share capital structure, you can see that there are 74 million shares outstanding, and there's all the options and warrants are out of the money at the moment. The main shareholders, about 35% tied up with 4 people, 4 entities at the moment, with Jim Rennan the largest shareholder. So the directors have about 16% of the company, so quite an incentive to make this work. Just before I go on to the final slide, I'll just say a couple of words about Nicaragua. You might say, why is our valuation so cheap compared with anyone else? Which is the first thing you want to ask me, perhaps. We own 100% of everything. That's the great news. We don't have to give 10% free carried interest to anybody in Africa, or 20% or 30%, depending where you are in Africa. So that's very good. One of the main reasons that the valuation is a third to a quarter of the peer group is linked in with the civil disturbances in Nicaragua last year. Between April and July, 325 people were killed, according to the United Nations. This was triggered in early April via the government putting up taxes. They misjudged that. They didn't take society with them. Students went on the streets, threw petrol bombs at police. And in that part of the world, you get shot if you throw a petrol bomb. There is not the staggered response of CS gas, rubber bullets, baton charges. It's live ammunition, I'm afraid. So that was a tragedy, and 56 students got killed in April over a 4 or 5 day period. I went straight out there 10 days after that started. I've been back 10 days since. There was a semi-curfew for about 3 months between April and July. And since July, it's been stable. There's been no demonstrations, no deaths like that before. But the US did put sanctions on Nicaragua in December last year. That's the first time they put sanctions on in the last 25 years. It has been a democracy for 28 years. So this political uncertainty has halved our share price in the last 12 months. So what I would say is they have a dialogue table going on at the moment. The Catholic Church is involved with the Cardinal from Rome. The professional mediators are involved. And they're looking to find a Nicaraguan solution to a Nicaraguan problem. But the US is there with a big stick, threatening sanctions and so forth against the company. So despite that happening in April and that 4 months of madness, we got permits to construct and operate a mine in August, and then we got another concession in December. So, and the producing mines and where we are, the troubles were in the capital and the big cities, and the operating mines have been operating fine for the last sort of 8 months or so. So, and the government clearly is prioritising mining because they obviously see job creation, foreign direct investment and so forth. But I thought I don't want to put that in black and white too much on a slide, although it's recorded in perpetuity, but I thought I'd make some comment about the valuation. So what's next for the project to wrap up? We've got the permits, major de-risk. I think that having got that, we really just go straight to the 120,000 ounce production when the other permits come through, bearing in mind that the 2 feeder pits being permitted, we're using the same processing plant and the same tailage storing and the same magazine, explosive magazine. So that should be relatively easy to permit. We can add another 1 million ounces, but we're not looking to do that in the near term. And we're looking to continue to demonstrate district play, which we're doing with continued rock chip and sampling protocol program, which we've got going on in the district. And every month I get a monthly report coming back, and there's an abundance of high-grade rock chips and soil rock chips predominantly, and trenches and cuttings that we get back all the time. So we have over 106 kilometers of epithermal veins on the surface. So it's a very big gold district here. So we've got to hope for a political solution in the not too distant future. But I would say at this juncture that a significant amount of negative news is in the share price. That's why already reflected where we are. And with that, I'll conclude and take questions.
Thank you very much indeed. So questions about the strategy perhaps, or what Condor's doing? Yep, got one at the front here.
How long yet to complete the fast start technical studies?
We've completed the studies on mini pits within the permitted pit. So the permitted pit's permitted to produce 600,000 ounces of gold. We've completed studies on 2 small pits within the permitted pit. My general manager, Isa Zaria, was at B2 Gold's for 6 years, and he's done 5 mini pits. So we can take about 10% of the permitted pit out according to those studies, so about 60,000 ounces of gold. And that would be high grading the 3 gram material. So there's an epithermal veins, there's high grade ore shoots, and so that material would be a minimum of 4 grams.
And would you work alone in exploiting this opportunity, or would you look again for partners? We've heard from some of the other companies.
With the comment regarding the mini pits, that was specifically with a view to us mining it, getting contract miners in, so blowing up the rock, loading it onto a truck and trucking it round to existing processing plant to get early cash flow within, say, 4 months of signing an agreement. We're under a confidentiality agreement with B2 Gold, so I can't comment too much about that. I would just say they're a very big gold producer, almost 1 million ounces, and this is a rounding error to them, and getting attention at the top table is challenging, although we certainly know in country they need the ore. Both the mines had their first quarter results out last week, and both are, the average all-in sustaining cash cost is $1,500 an ounce compared with today's gold price, so they're losing money. They have spare capacity at one of the mines in particular, and our high-grade ore would make sense for them and make sense for us. In terms of the project, would we joint venture with someone on this project? We would be open to suggestions. I suspect that until there's a solution in Nicaragua politically, it would be quite a big ask for someone who's not there to actually come into the country to get comfortable with it. The upfront capex to the project on the PFS number is $110 million US. We are looking at other ways of gaining early cash flow, including these are just the scenario planning of how do we get early cash flow. Well, one way is we could buy a second-hand mill, have a smaller plant of say 1,000 tons a day, which would get us into 40,000 ounces of gold a year straight off. That would make sense for us to do. So it might be in the context of Nicaragua today, we don't go straight for the big mine. We go a pilot plant, let's call it a big pilot plant at 40,000 ounces of gold a year. And you can do the maths on that at 4 grams. It'll throw out quite a bit of cash flow because they're all in sustaining $700 an ounce at 3 grams. I'm saying we could high grade it so that can come down and make us self-sustaining. And I think that the key thing is we got the permits to construct up to 2,800 tons a day. So if we construct 1,000, the government's happy with that. We create jobs and we get the project going, and we do this in 2 steps. So that is something we're looking very hard at the moment.
So would it be unfair to say that investors have got to be pretty patient in the medium term?
I think it's the nature of this industry. You've got to be a bit patient. It's a long game getting something permitted. It's taking mines longer and longer to get permitted than ever. The average time in Canada is now 5 years to get a mine permitted. And I suspect in the UK it's not an awful lot different for something of this size. So it is a long game, and I think investors quite often overlook that. They don't have that time horizon, particularly going through a permitting phase, because there's often no attractive news going through a permitting phase. It's really rather dull from a stock market perspective. But we're through that, and we're good to go. I think it would be incumbent on us to show a really clear route to cash flow as soon as we can.
Fine. Okay, well, it's been a great explanation and interesting in a way that you're a military man with some of the issues you've had to deal with in Nicaragua. I'm sure your particular expertise came in handy.
Well, I've 15 years operating with Condor now, so it's significantly longer than
a long time
mine,
ago,
a 4-year short service commission. And I should probably rewrite my bio on the back of that. But I actually had 20 years in finance and private equity, and then 15 years with Condor since then. So
okay.
Thank you.
I'm sure it came in handy. Thank you very much. And on to Paul Mylchreest, who's a mining analyst with Hardman&Co, an equity analyst, long experience, 30 years, starting in the chemicals sector. He was Extel rated. Do you remember when we always used to look for the Extel rated analysts? Had a brief foray into oil and gas, worked for several years as a global macro and cross-asset strategist, began his mining coverage at Credit Agricole Chevrolet in 2005 and joined Hardman in early 2018. He holds a B Soc C in money banking and finance from the University of Birmingham. So let's hear now from Paul, and I think he's going to talk in particular about gold, and obviously rather timely. It'll be interesting to hear why he's picked gold for this evening.
Okay, thanks, Nigel. Good evening, everybody. Tragedy and hope, which I've borrowed from Bill Clinton's mentor, Carol Quigley. From my experience in gold, there's been a hell of a lot of that over the years. I think the needle is moving more in the direction of hope now than it has been for a long time. I think central banks are really pushing the current iteration of the Bretton Woods currency system towards its limits. I think as I lay out some of the issues there, the big picture argument for gold, the arguments are becoming more compelling. That said, if you know the gold market, you know that it's not just the merits of the investment case that's critical for the gold price. And what I think is important, I'll talk about towards the end of the presentation, is I think there is a chance that the fundamentals for gold could be reinforced by some disruption to the status quo in London. My starting point, though, is going to be our position in the debt cycle. What I show here is that we're in the fourth debt cycle since the Industrial Revolution. I'll go through a classic debt cycle with you in a moment. Not surprisingly, what you tend to see is a protracted rise in debt until the latter stages of the cycle. And eventually the system becomes overwhelmed by debt. Typically, the final phase of the cycle is brought on by an equity market crash. And in that final phase, in the first three cycles, what we saw was that the debt load was purged by debt deflations. They purged the asset bubbles as well. And I asked the question, will it be different this time? As we look at the current cycle, it is the longest by far, 85 years and counting. The final phase of this cycle, as I'll show you, is heavily distorted. And that's really because of our central banking friends and their hyper-interventionist policies, and the fact that the previous three cycles we were essentially on a gold standard. Let's just talk about gold in debt cycles, though, briefly. It's important where we are because gold has performed very strongly in the last stages of previous debt cycles. What I show you there, what I call the winter phase, the final stage of each cycle. On the right-hand side, you can see the actual performance of gold and its performance in real terms, which is important because they were deflationary periods. And I'd urge you to really contrast how gold performed in particular versus stocks. I think it's pretty clear. And I think as we go into the last stage of this debt cycle, the question to me is, do we, as we've seen before, have a debt deflation which brings this cycle to an end, or actually will it be inflation this time? I have my own view on that. To walk you through a classic debt cycle, what you can see there, you can see that the four phases, the seasons, if you like, the spring phase, the rebirth of the economy as debt begins to rise slowly. The summer phase, the growth in debt tends to accelerate. The autumn phase, and then the crash into the winter, which is really the payback and economic collapse, and then the cycle tends to start again. And what I show you at the bottom is in each phase of the cycle, what really you should buy in terms of asset classes, what you should sell, and you'll see that typically gold does well in the summer phase and also in the winter phase. Moving on, show you what happens to pricing in a debt cycle typically. You may know of this as the Kondratiev cycle. Typically, you have benign inflation in the first part of the cycle, and then you have the inflationary summer phase, which is not surprisingly one of the two phases when gold does extremely well. Then you move into the deflation stroke disinflation phase in autumn, and then finally deflation in winter. Isn't it interesting this time around when the Fed has tried to raise rates and normalize interest rate policy and is already backing off that? Interest rates, they tend to follow prices over that cycle. And as I say, you know, we're seeing what the Fed is doing in terms of backing off. And then GDP growth tends to be very rapid in the first half of a debt cycle, tends to slow down in the autumn phase where we feel good, but we mainly feel good because we're seeing these debt-driven asset bubbles, and then everything goes wrong in the last phase. And I say in that chart, you know, we should be in this deflationary phase. We've had two equity market crashes, one in 2000, one in 2008, but really the unfolding of the final phase is on hold because of the central banks. And we're in a situation where we're really stuck because we're seeing a fight to the death, if you like, between the forces of deflation, which is inherent in this stage of the cycle, and then the pushback, the inflationary pushback of the central banks to try and retain the status quo. Deflationary force is pretty obvious. We're now looking at a global debt bubble, almost $250 trillion. If you think about it, debt has a time function because it allows you to bring forward what would be consumption from the future into the present. So debt, in a way, buys you time. And as I say, we've bought a hell of a lot of time. On the other side of the equation is the inflationary pushback from the central banks. Not to put too fine a point on it, this is the heavy hand of central planning. After 2000 and the equity crash, then we saw Greenspan cut rates to 1%. That was unprecedented. He left them there for a year. And then this time around, post the great financial crisis, we've seen ZIRP, NIRP, and 15 trillion created out of thin air by the central banks. And I say, meanwhile, back in the real world, but the real world this is the result of central bank policies. We have, in my opinion, serial financial bubbles in assets except gold, mainly stocks, bonds, and real estate. And as we've seen, every time they try to reflate the cycle and extend it, they need more extreme stimulus and they create a bigger bubble every time. My sort of question really is, the central banks, you know, you have to give them their due. They succeeded in righting the ship after 2008. But has what they've done, will it be enduring? Or alternatively, has it really just obscured structural weaknesses, which are very profound? And in hindsight, we'll see that central banks have actually overreached themselves. Now, what I want to do is just explain why I think the task for the central bankers is going to get considerably more difficult in the months ahead, because what you're going to see is the debt bubble converging with a series of factors. One of those is the extended nature of our current economic cycle. So we're just 1 month away now from it being the longest post-war expansion. It's actually almost the longest expansion in just over a century. What you see on the right-hand side as well, it's interesting, we're talking about the debt cycles and how GDP tends to slow as the cycle progresses. You can see that's the lowest rate of GDP growth we've seen in terms of these expansions, because essentially the debt is starting to act like a tax on the growth rate. What are market-based indicators starting to say? One thing that's always worth looking at is the yield curve. So what we saw in December was that the belly of the US Treasury yield curve started to invert on the 3rd of December. It was the 3s and 5s. When we've seen yield curve inversions before, with one exception, which was 1995, we've always had a recession within 2 years. And the 1s, 2s, 2s, 3s are currently inverted at this moment. Something else to think about, there's a dollar shortage outside of the US. I don't know if this is something you've looked into, but the top left chart just shows how it was a dollar shortage that really was one of the early signs of the crisis beginning in 2007, 2008, when you saw LIBOR diverge from the Fed funds rate on the 9th of August 2007, and then it all went downhill from there. I'll just draw your attention to the bottom left chart. That is something called a cross-currency basis swap. What it's showing you is if you want to swap dollars into euros, over and above the relative difference in interest rates, you have to pay a premium to swap euros into dollars in this point because it's below zero. And this premium to swap dollars has opened up again. Essentially, there's a dollar shortage outside the States, and it's the Chinese banking system is certainly at risk here. Because what's happening is that regional banks outside the US are lending dollars long and they're borrowing them short in the euro-dollar funding markets. And they keep having to roll over that funding, and because of things like Basel III and risk aversion and things like that, there is less dollar balance sheet on offer. And that is a real threat. Now, it could be, the Fed could quite easily come to the rescue here if it started laying out dollar swaps like it did after the last crisis. But that's an interesting question, because my convergence number 4, where I say, you know, the political and financial order really might have changed in 2016 with the election. So we'd been on this long road towards globalism, and then all of a sudden up pops Trump-style nationalism. And it was interesting, you saw this report in the Telegraph back in January, where the number 2 in the IMF was saying, you know, if we have another financial crisis, will the Fed cooperate as it has done in the past with a Trump White House? Obviously, we've got a lot of trade tensions at the moment, and on the right-hand side, I'm just showing you what's happening to world trade volumes, which perhaps brings this issue into more focus. Anyway, what I want to do now is just show you how 2 factors contributed to the first modification of our Bretton Woods currency system, of which gold was very central in that, and then just ask whether you think things may be repeating themselves, because that's my sense at the moment. So if we look at what happened 1968 to 71, I would argue there was a 2-fold loss in US monetary discipline. The first was in the when deficits started to surge in the late 1950s, and then the second phase of this was when policy cooperation began to break down between the US and other nations in the late 1960s, which was when the US budget deficit spiked again because of the Vietnam War. And what you saw in the end was that France and 1 or 2 other nations broke away from cooperating in the US, and they wanted to transfer their dollars into gold, and that's what broke the gold cap at $35 an ounce, and then we saw that 1970s gold bull market. What I think is interesting at the moment is I would argue that we are going through another two-stage loss of US monetary discipline. I think the first stage was the response really to the crisis between 2008 and 2015. Since then, we started to see the Fed running off its balance sheet and also raising rates. I think things really started to change, though, in December 2018, where that's the Fed's dot plot on future interest rate hikes, and you saw it start to roll over. So as we went into that December 2018 FOMC meeting, the market was expecting 3 rate increases in 2019, possibly another one in 2020. And as we know, this is all on hold now as the Fed says it will be patient regarding any future increases. And then on the right-hand side, we're looking at trillion-dollar deficits really as far as the eye can see, thanks to the administration's tax cuts and heavy spending. Let's come back to gold. I think we have some very positive gold fundamentals. On the left hand at the top, what you can see is that last year we saw the biggest accumulation of gold by central banks since 1967. On the right-hand side, again, was it interesting? We talked about the Fed's capitulation on monetary policy in December 2018. That was the very month where China, after a 2-year hiatus, started buying gold again. Bottom left just shows gold demand, what might be called the Silk Road, if you like, China, India, Russia, and Turkey. And then on the right-hand side, you can see that the premium for gold in China versus the London price has begun to rise again. Having said all that, in terms of big picture, what's going to be critical is the mechanics in the London gold market. And this is, in my opinion, where the tragedy of that tragedy and hope really comes out. So if you look at the gold trading in London, what you have is a situation where actual physical bullion is almost entirely eliminated from the price setting process. Now, some of you will be very knowledgeable about this. If you're not, just very briefly, gold trading in London, which people think of as the hub of the physical market, has essentially been derivatized. So at least 95% of trades are in something called unallocated gold, which is an IOU for gold. It doesn't actually require delivery of physical bullion. What that means is that if you're potentially a seller of gold, there's very little risk that you'll be called on to deliver bullion. So what you have is gold demand, which is essentially diluted by, if you like, a factor of 20. And you have a very elastic gold supply in this situation. And what that means is that the price discovery is naturally going to be biased significantly to the downside, in my opinion. That's just the mechanics of this market. And it's interesting, if you look at the gold price, I did 2007 to 2012 just because someone had done a very good chart on this. What you can see is during London trading hours, that's the bottom left chart, the gold price tends to be heavily skewed to the downside in terms of intraday performance. On the right-hand side, just show you something. It was interesting that in the run-up to QE3, which many people talked about as QE to infinity in September 2012, there was no correlation in the previous 12 months between the gold price and the yen. Now, as soon as we had that massive change in central banks where they started to pump liquidity into the global economy, all of a sudden you saw the gold miraculously pegged to the yen. And it stayed there for a long, long time, right through to the end of 2017. I think it's just interesting, very quickly, to look at the gold bear market from October 2012 to December 2015. The gold price crashed 41%, in my opinion, precisely in the opposite direction to market fundamentals. Very briefly, on the left-hand side, you can see where the biggest fall took place. The lines have faded a little bit, but that was in Q2 2013. Now, the World Gold Council shows the surplus or deficit in gold supply and demand in every quarter since 2010. The biggest deficit in gold bullion supply, according to the World Gold Council, was in the second quarter of 2013, in the last 9 years, which was exactly when the gold price collapsed the most. That is inexplicable. On the right-hand side, rather than using the World Gold Council, I put together 4 major identifiable sources of gold demand. So central banks, ETFs, Indian imports, and withdrawals on the Shanghai Gold Exchange. And you can see the rising trend through that period. Perhaps even more interesting from my perspective, what went very unnoticed was that the UK export data from the Office of National Statistics showed that 2,200 tonnes of gold left UK shores during that period. Essentially, there was a hidden run on the gold vaults in London. And what I do on the right-hand side is just calculate what I think was left in terms of the float of gold that supports LBMA gold trading by December 2015. So if you take the total gold in the vaults, take off the official gold held by central banks at the Bank of England, take off the ETF gold held in London, and take off a little bit for institutions, sovereign wealth, high net worth, etc., you had about 968 tonnes. Compare that with about 5,000 tonnes per day of gold trading in London. And what you can see is that in the absence of the market practice of trading unallocated gold, London's gold vaults could have been out of gold within 24 hours. It got very, very tight, but nobody realised. Now, going forward, there is some hope. I say the growing possibility that the confidence trick in the gold market could become apparent. The reason being that performing that same analysis now, what you see is that the gold vaults in London may be even more depleted in terms of the gold float supporting trading than they were in December 2015. On the bottom left, that's the gold lease rate, so the cost of borrowing gold. What you see is very recently it actually spiked up to the highest level we've seen since, guess when, December 2015, when I think the vaults were under severe pressure. On the right-hand side is the palladium price. So we saw palladium lease rates spike to between 20 and 30% during periods earlier this year. And we saw the palladium price went parabolic. So, you can see what can happen if we get very tight on gold. This is not going to be an easy process, because even if the vaults come under severe pressure, you would expect the official sector, at least initially, to lend to the London market. My question would be, how long would they do that if they felt that they were not going to get that gold back at some point? So what I'm saying to you is we saw a run on the gold vaults between 2012 and 2015 in London of about just over 2,000 tonnes. The way things appear to stand at the moment, we wouldn't be able to cope with a run on the vaults that was half that strength or even less this time. Finally, we know the situation, sadly. The investment community is still not interested, even with, that's the chart of the GDXJ, so the Junior Global Gold Miners ETF. One thing I'd just like to point out, though, this is a curiosity that piqued my interest anyway, is sector M&A and Barrick Gold's recent deals or attempts at deals. This company has very long-standing establishment ties. Just to go back to the last gold bull market, so to give you the date, it was the 25th of June 2001. The gold price was $272 an ounce, so just above the low of 252. Barrick announced a $9 billion merger, if you remember, with Homestake Mining. Fantastic timing. We had a 10-year bull market halfway through, 31st of October 2005. Gold price was $471 an ounce, and Barrick announced the $10.4 billion acquisition of Placer Dome. They have a great track record of well-timed deals, and we've seen them very active recently. There we go, a little bit of hope. Thank you very much.
Thank you very much. Well, a lot to think about, and as to how all that translates into investment strategies, I think could probably be the scope for another entire talk. But any questions finally for Paul?
What do you think for the next 6 months, Paul?
What do you think for the next 6 months in the gold price?
Yeah, I think we're in the early stages of another bull market. Do I think things are going to get, positively out of control from the vault situation? Probably not within 6 months. My hope, to use the operative word, really is I think making specific targets is a mug's game. My gut feeling, and it's nothing more than that, is that I hope when we get beyond the next US election that we have another, we challenge the all-time high again after that election.
And the sort of safe haven buying we've seen in the last few days, I mean, I suppose in some ways that might link back to what you were saying about US policy, central banks and so on, but it's also about trade. Is that semi-detached from what you've been talking about?
No, whilst I'm expecting a sort of a takeoff in the gold price. That's the trajectory is relatively modest from here to begin with. The great thing about, I think, gold at this point is you have it's a series of options at the same time that somebody drops the ball in terms of a trade spat, or for instance the dollar shortage comes comes into focus again, something like that.
Okay, and we've got a question here.
Could Vodafone's 40% cut in dividend today be the trigger for a whole stack of other stressed businesses, and the likes of BT, Centrica, BAT spring to mind, and see a re-rating of the yield on the FTSE, and as a consequence, investment looking for alternative homes rather than sitting back and picking up 8-9% yields?
What do I think? I mean, pressure on yields. Obviously, it's going to make gold relatively, look more attractive. But, is that? I don't think that is going to see necessarily a sea change in global gold, attraction just from specific companies. What I think may be more realistic is and what we've seen recently is. We've got a very extended stock market. If we see jitters in that, then yeah, I mean, it's gold, and it's, look what's happened to the crypto market again. People are looking at those safe havens, but I don't think Vodafone makes a big difference.
I was thinking of Vodafone on its own, that somebody's actually one of the big dividend payers has actually come out and said, right, we're cutting. And there's an awful lot more of the big dividend payers in the FTSE might just use that as an excuse to.
I hear what you're saying. What I think is your average fund manager who is generally very negative to gold, and in the last two gold bull markets, they were massively wrong-footed. It's going to require some real shock treatment, I think, to get them to open their eyes to investing in gold. And I think it takes a severe move down in the stock market, or a severe breakdown in trade relations, something like that, to move your UK fund manager into thinking, hey, you know what, where are those gold companies?
You're not suggesting cryptocurrencies are a kind of digital gold now, or seen that way by some?
Some people do see them that way. I know what I'd prefer to invest in, but I've got a bit of both.
Okay, well, one more question over here, and I think.
Or can I just ask a question, please? Why do fund managers not like gold?
I think it almost, for them to buy gold, I think they have to write off to some extent the economic outlook and a lot of their stock picking, because they feel gold and even gold stocks is generally a very passive way, I think, to invest, and really nothing more than insurance. And it takes them an awful lot to drag them out of that. And I think the other thing is that the media and central bankers are almost uniformly negative on gold. And I think, and the fact that, you know, we're so long since we had any kind of gold standard or gold exchange standard, that it's just not part of their, you know, their day-to-day experience. They're not interested.
And the last question over here.
In relation to your presentation, you don't actually talk about, let's say, how do you actually take out things like poisonous chemicals out of extracting gold, like mercury and cyanide? Is there any new innovations which are coming along which are eradicating the use of these toxic chemicals?
No, I mean, I don't know, Mark, if you've got any view on that. I haven't seen, I don't think there's any sea change in terms of gold market technology that's going to...
Extraction, more like, yeah.
That's going to rapidly transform.
I'll just project my voice. The gold, 20% of the gold around the world is mined by artisan miners illegally in the Amazon jungles in Nicaragua and Africa. And they're almost all using mercury. We have the Minamata Convention which bans mercury, but these poor countries use it because there's often no alternative form of livelihood for them. 90% of the world's gold producing mines use cyanide and have a cyanide code and cyanide destruction units. In one way or the other, they're using cyanide either through a carbon in pulp or a carbon in leach mechanism or a merrill-crowe mechanism. Those are the three main. Gravity separation you can use in some types of gold, but it's often only gets half the gold out by a centrifugal crushing, grinding, and a centrifugal force. So although you mentioned they're dangerous chemicals, but actually it's not the listed gold producers who you need to worry about. The Barricks and the Randgolds, or merged New Barrick if you like, they're all signed up to Equator Principles IFC form, and they have cyanide destruction units, on the back of which if water goes into a tailings pond, a bird can often drink off the back of it, theoretically. So they're not the bogeyman that people make them out to be in terms of the extraction methodology. I don't see any change in it either. There's nothing really on it. It's very efficient the way it is.
Okay, thanks. Any more questions? Just one more. Oh, sorry.
In terms of your figure for the flotation, your 802 to support the OTC trading, how rigorous is it?
Okay, so in terms of that figure, what we get now is the LBMA on a monthly basis produces the total volume of gold in all the London LBMA registered vaults. The Bank of England does the same in terms of its own vault. So what we can do, bearing in mind that the vast majority, and I assume 95% of Bank of England gold is official gold, then we can take that off the total. We then need to make an adjustment for ETF gold. Now that's relatively easy to do in the sense that on an annual basis, each of these ETFs publishes a prospectus. They tell you where the gold is, so we can do that. And I've done that over the years. And the last time I did it, London-based gold was about 71% of all the gold in gold ETFs. So I use 70%. I mean, you know, I will test it again probably the end of this year, but it's been there or thereabouts. And then you have to make another small adjustment for, as I said, sovereign wealth, high net worth, etc. So I'm reasonably comfortable with that figure. The only problem we have, to an extent, is that the LBMA and the Bank of England are typically producing this data 3 months in arrears, which is very convenient for them and less convenient for us.
Okay, well, thank you very much indeed to Paul Mylchreest.